January 20th, 2026. You're scrolling TikTok right now, or this is playing in the background while you swipe past charts, headlines, memes, whatever keeps the feed moving. Stop scrolling for a second, because what I'm about to show you is the exact pattern that played out before. March 1980, when silver collapsed 50% in 4 days and wiped out billions. September 2008, when money market funds broke the buck and the entire commercial paper market froze overnight. March 2020, when treasury markets, the most liquid on earth, stopped functioning for 48 hours. In every case, prices looked fine. Volatility was manageable. Experts said the system was resilient, and then the plumbing failed. Not the market. The infrastructure underneath the market. The clearing. The delivery. The physical settlement that everyone assumed just worked. Here's what most people missed in all three cases. The crisis didn't start when prices moved. It started when flexibility disappeared, when inventories thinned, when backup systems got retired to cut costs, when the people running the machine stopped asking, what if this breaks? Right now, January 20th, 2026, silver just crossed $33. Analysts are calling for $50, $75, maybe $100. Trade war fears are escalating. Industrial demand is spiking. Supply chains are fragmenting. And if you're half watching this while your feed keeps moving, here's the only thing you need to understand. This is the phase people miss. Not the crash, not the explosion, the tightening, the part where the system still works, but only because nobody's testing it yet. March 1980, the Hunt brothers didn't lose because they were wrong about silver. They lost because they didn't understand that controlling the metal means nothing if you don't control the clearing system, the margin requirements, and the political will to stop you. They had the supply. They didn't have the plumbing. Fast forward to today, silver inventories are at 8-year lows. Refining capacity is maxed out. Delivery timelines have stretched from weeks to months. Sovereign buyers, China, Russia, India, are accumulating off-market. Industrial users are panic buying just to keep production lines running. And the people selling to them, they're not miners anymore. They're central banks. This isn't speculation. This isn't a Reddit squeeze. This is statecraft. And the danger wasn't in the price, it was underneath it. If this walk through financial history sharpens how you see risk, liking the video quietly tells the system this work matters. Now, let's talk about what happens when an industrial metal becomes a monetary weapon. Picture a metal that sits at the intersection of three impossible tensions. First, silver is an industrial commodity. Solar panels, electronics, EV batteries, medical devices, modern civilization runs on it. Demand is structural, non-negotiable, and accelerating. Second, silver is a monetary metal. For most of human history, it was money. Central banks still hold it. Investors still hoard it. And when trust in fiat systems cracks, people don't run to copper. They run to silver. Third, silver supply is inelastic. You can't just drill more. Most silver comes as a byproduct of copper, zinc, and lead mining. When those mines slow down, silver dries up, regardless of price. So you have industrial users who need it, monetary buyers who want it, and miners who can't deliver it fast enough. That's not a market. That's a structural trap. And right now, three forces are converging to spring it. One, a trade war that's fracturing global supply chains. Two, a green energy transition that's consuming silver faster than it can be replaced. Three, a monetary system where central banks are quietly shifting reserves away from dollars and into hard assets. The price you see on the screen, that's the headline. The plumbing underneath, the inventories, the refining bottlenecks, the delivery failures, that's the story. And the story is about to get ugly. Let's go back, not to 1980, further. 1971. Nixon closes the gold window. The Bretton Woods system, the architecture that had governed global money since 1944, collapses overnight. Gold stops being money. Silver, which had already been demonetized domestically in 1965, becomes what exactly? An industrial metal with a monetary legacy, a store of value with a spot price, a strategic resource without strategic classification. And here's the assumption that shaped everything that followed. Silver supply would always match demand, because it always had. When industrial demand spiked in the 1960s, mines ramped up. When investors piled in during the 1970s, scrap recycling absorbed the pressure. The market worked. Except it only worked because silver wasn't mission critical yet. You could substitute, you could delay, you could economize. Not anymore. Today, silver isn't optional. It's the most electrically conductive, thermally conductive, and reflective metal on Earth. You can't build a solar panel without it. You can't manufacture semiconductors without it. You can't hit decarbonization targets without it. And the assumption that supply would flex to meet demand? That assumption quietly died sometime around 2015. Nobody rang a bell? From 2000 to 2020, something remarkable happened. Silver prices stayed suppressed, even as global solar capacity grew 100x. EV production exploded. Electronics penetration went vertical in emerging markets. Why didn't the price reflect this? Because mine supply kept pace, barely. Primary silver mines delivered steady output. Byproduct supply from base metal operations filled the gap. Scrap recycling picked up the slack. The system balanced. Investors believed the story. Silver is abundant. ETFs grew. Speculators played the volatility. Industrials locked in long-term contracts at stable prices. Everyone got what they wanted. But they paid a price most didn't see. Exploration budgets collapsed. New mine development stalled. Refining capacity stagnated. Inventories thinned. The London Bullion Market Association, the clearinghouse for physical silver, started showing strain. Delivery delays crept in. Premiums over spot price widened. And quietly, the plumbing started to fail. Not catastrophically, just incrementally. A few weeks of backlog here, a force majeure clause there, nothing that made headlines, but enough to signal something dangerous. The buffer was gone. 2020. COVID hits, mines shut down. Refineries go offline. Supply chains fracture. Industrial buyers panic. And for the first time in decades, physical silver becomes hard to source. Premiums explode. Retail buyers in the US are paying $8, $10 over spot. Mints run out of stock. Dealers impose allocation limits. The divergence between paper, silver, futures contracts, ETFs, and physical silver, the actual metal, becomes impossible to ignore. Reddit notices. Our Wall Street Bets launches the Inventories silver squeeze movement. Retail investors pile into SLV, the largest silver ETF, convinced they can force a short squeeze. They were right about the shortage. They were wrong about the mechanism, because the real squeeze wasn't happening in futures markets. It was happening in the delivery system, and it wasn't retail driving it. It was sovereigns. Pay attention to this part. In 2022, central banks became net buyers of silver for the first time in over a decade. Not gold, silver. China, Russia, India, all quietly accumulating. Not through exchanges, through bilateral deals, off-market purchases, direct mining agreements. Why? Because silver has a dual function that gold doesn't. Gold is a monetary hedge. Silver is a monetary hedge and an industrial weapon. If you control silver supply, you control solar panel production, battery manufacturing, semiconductor output, defense electronics. This isn't speculation. This is statecraft. January 2025. The new U.S. administration announces sweeping tariffs on Chinese goods. China retaliates, if not with tariffs, with export restrictions on strategic materials, rare earths, graphite, and silver. Not a ban, just administrative delays, licensing requirements, quality inspections that take weeks instead of days. The effect is immediate. Western manufacturers can't source enough refined silver. Spot prices spike 18% in 3 weeks. Industrial buyers who had relied on just-in-time delivery suddenly face a terrifying question. What if the metal just stops coming? Panic buying begins. Not speculative, precautionary. Auto manufacturers, solar developers, electronics firms, they're not trying to profit, they're trying to survive. And the people selling to them? They're not miners. They're central banks and sovereign wealth funds and strategic reserve managers who bought at $18 and are now offering at $35 with conditions. Long-term supply agreements, technology transfer clauses, political concessions embedded in commercial contracts. This is how power shifts, not through war, through plumbing. Let's be very clear about who wins and who loses when a critical commodity market breaks. Winners, early accumulator nations, China, Russia. Primary silver mining jurisdictions, Mexico, Peru, Chile. Vertically integrated firms that control both mining and refining. Losers, or just-in-time manufacturers with no inventory buffer. Western economies dependent on imported refined silver. Retail investors who bought paper exposure without understanding counterparty risk. But the deeper consequence isn't economic, it's strategic. For 50 years, the US dollar has been the dominant reserve asset because it sat at the center of the global commodity trading system. Oil priced in dollars, metals cleared in dollars, trade financed in dollars. That architecture is fracturing, not because of ideology, because of incentives. When trade wars disrupt supply chains, nations start securing resources through bilateral agreements denominated in local currencies. When sanctions weaponize the dollar, central banks diversify into hard assets that can't be frozen. When industrial bottlenecks threaten national security, governments stockpile physical commodities, and the entities that control those stockpiles gain leverage. Silver is small. The global silver market is maybe $25 billion annually. Tiny compared to oil, gold, or treasuries, but it's a test case. If a critical industrial metal can be cornered, not by speculators, but by sovereigns, then the assumption that markets are bigger than states collapses. And the next time there's a supply shock in lithium, cobalt, or rare earths, the playbook is already written. I'm not telling you silver is going to $100. I'm telling you the structure that would take it there is already in place. Here's what's already true. Global silver inventories are at 8-year lows. Industrial demand is running 15-20% above mine supply. Refining capacity is maxed out. Delivery delays are now measured in months, not weeks. Sovereign accumulation is accelerating. Here's what happens if stress continues. A major refinery goes offline for maintenance. A mining jurisdiction nationalizes output. A geopolitical flashpoint disrupts logistics. Any of these, and the physical market locks up. Not the futures market, the actual metal. And when industrial buyers can't source supply, they don't just pay higher prices. They stop producing. Solar installations delay. EV production slows. Electronics manufacturing shifts. And economies that were betting on green transitions suddenly face a choice: compromise on climate goals, or pay whatever it takes. Prices are the headline, plumbing is the story. And right now the plumbing is failing in slow motion. Here's what 1980 taught us. You can corner a market, but you can't corner the system. The Hunt brothers controlled the metal, but not the clearinghouse, not the regulators, not the political will. Here's what 2025 is teaching us. You don't need to corner the market. You just need to control the refining, the distribution, the last mile logistics. And if you're a sovereign nation with strategic patience, you don't even need to announce it. You just slow things down, a permit here, an inspection there, and suddenly the industrial world realizes the metal they thought was abundant was only available because someone else allowed it to be. History doesn't repeat events, it repeats incentives. And the incentive structure around silver right now looks a lot like the early stages of a controlled implosion. Not dramatic, not sudden, just inevitable. 2 takeaways. 1 about systems. Markets assume supply is elastic until it isn't. And by the time prices reflect the shortage is already structural. 1 about human behavior. We optimize for efficiency until efficiency becomes fragility. And we never see the fragility until the system stops working. Silver might go to $50, it might go to $100, or it might stay range-bound while the physical market quietly fragments into a 2-tier system. Paper prices for speculators, and negotiated prices for those who need the actual metal. Either way, the era of abundant, cheap, globally accessible silver is over. And the people who understand that aren't the ones watching the price. They're the ones watching the inventories, the refinery schedules, the shipping manifests, the sovereign purchase agreements that never get reported. If this helped you see the system more clearly, consider liking this video and subscribing to the channel. Not for predictions, but for perspective. Because in markets like this, perspective is the only edge that lasts.